Hi everyone, welcome to the Sydney Consulting Club case study approach on fundamental financials. So today we'll be covering a few things, just running through briefly on the income statement and balance sheet. We'll also be assessing the viability of a strategy. And finally, we'll go over the case study again, which is Australia Post. So just a brief recap of what we've learned through the workshop so far. So we learned about the preliminary research in understanding about the business and its industry. And we've also learned about the client problems, which will vary from case to case. And it's also essential to define the problem and also to understand identify the problem and not address all issues simultaneously, and prioritizing which problems are the most important. Finally, we learned to apply the 80-20 rule to develop a strategy. Now, without further ado, I'd like to present our guest speaker. He's a Bachelor of Commerce and Law in his 4th year. He has plentiful of experience in investment banking, and he was an academic tutor for financial valuations. Could you please give a warm welcome to Dawen Lin?
Thanks, Raj. We put up a link earlier, if you can. Just type it in. I've sort of made a spreadsheet that we're going to move throughout the hour. So if you can download that. Cool. Can everyone hear me down the back? Good? Cool. All right. So basically, today we're going to try and run through some financial valuation techniques, essentially. But I think before I even start any of this, the one thing that I really want to point out is financial valuation is very, very subjective. Okay. And the other key thing is, I think for those of you that are potentially doing maths majors or whatever, you guys might be very bogged down on the numbers and things like that. And I probably shouldn't be saying this as a finance tutor, but the numbers honestly don't matter. Okay. And what I mean by that is, as long as you have your recommendation, you can always make up numbers to suit whatever story you want. So don't get too bogged down into the sort of decimal place and the exact numbers and whatnot. So focus on all the other things like your strategies and whatnot. But the finance is just a way to back up what you're trying to say, essentially. So make sure your numbers sing the right story that you're trying to tell. But then at the same time, just make sure there's no blatant errors in your model and whatnot. And obviously, the thing to keep in mind is no one's going to check your calculations or anything. If you are doing a case comp or whatnot, no one's going to sit down and check all of your numbers. So it is imperative that you really get your strategy right. And as long as there's no silly errors within your numbers, you're pretty much set to go. Now, what I'll do to start with is briefly run through the 3 financial statements. Now, these are sort of generally how your financials will probably come in any sort of situation, I guess. Firstly, just starting with the income statement. Now, this one's probably the most important one that you will look at, and when I sort of speak about how to value certain things, we'll be focusing predominantly on the income statement. Now, can I just get a show of hands how many of you guys are sort of finance majors and accounting majors? Can they go a bit up higher so I can see what's going on? Okay, so looks like half of you. So I'll try and sort of speak as simply as I can with these things, but if I do say any sort of lingo that doesn't make sense to any of you, just shout out and I'll try and clarify it. But basically looking at your income statement, what you're really looking at is how much money you're making within a given year, essentially. Starting from your revenues and then looking at how much expenses are going out of your company. And then you see you go line by line all the way down to your NPAT, which is your net profit after tax. Now, the key things we're going to focus on here is essentially your revenues at the very top. Now, when I speak of revenues throughout this session, what I'm referring to is your total revenues, essentially. But sometimes you have sort of accounting things where you split revenues into sales revenue as well as total income. We won't worry about that. In terms of expenses, you can see there's on number 4 and number 5, those are both classified as expenses. Generally, you have something called a cost of goods sold, which is thinking about the revenue that you're making and how much it takes, essentially like production costs, think like that. And then your selling, general and administrative expenses, which is probably more of your standard expenses that you think about. So I'll talk about operating expenses, and anything I talk about expenses is basically 4 and 5 together, okay? So really just concerned about revenues and expenses. And that flows down to your EBITDA, your earnings before interest, tax, depreciation, and amortization. Very, very long word. Don't worry about it too much. Just remember the terminology, I guess. And then that's basically going down to your EBIT, which is the predominant thing that we're going to focus on today. And I'll explain a lot more of these as we go, so don't be too worried if you don't understand now. Now, the balance sheet. It's a statement of financial position looking at, in a given year, what are your assets, what are your liabilities, how much sort of assets you're holding and how much things you owe to other people as well. But we won't be too concerned about this, just for fullness sake, I'll have it here. And then finally, cash flow statement, just thinking about how much money is flowing in and out of the company. Yeah, and yeah. Cool. Now, this is where the bulk of it will be in terms of how to assess the financial viability of something, essentially. So one thing I might point out for the finance students here, I'm dumbing this down a lot. I'm not necessarily going through in as much detail as you would probably learn in your finance courses, because I just don't believe it is necessary in a consulting context to be that rigorous with your evaluations, I guess. So back to the point I was saying originally, essentially, that your numbers are just a backing mechanism more so than anything else. So just keep that one in mind if anything I'm saying doesn't necessarily sit well with you and what the lecturers are spoken about in your other finance courses. Now, the key question we're trying to answer here is essentially, if I have a project, how do I decide whether or not I should undertake it or not, right? So think about, I don't know, you're a company, you have a certain investment opportunity. Should I invest in this project or not? And the answer to that from a financial perspective is to look at your net present value, which I've got up here. So I think for those of you that haven't heard of this, the key thing really is this one statement that $1 today is not worth the same as $1 tomorrow. Now, I remember when I first heard about this, I was like, whoa, this is mind-blowing. Like, what does this mean? What do you mean $1 today isn't the same as $1 tomorrow? I've got a $1 coin in my hand, it means the same thing, surely. Now, does anyone want to sort of jump out and, I won't ask too many questions, but this is a point where I will ask a question. But does anyone know why that is true? Why necessarily $1 tomorrow is not worth the same as when I have $1 today? Just shout out. Yeah, essentially, right? So if you think about that $1, say I have $1 right now, what can I do with that $1? So I can do certain things and necessarily pretty much just invest in the money, and by tomorrow I'll have more money. So say if I had $1, I decided to put it in the bank for a day, and let's say the daily interest rate is 5%, which it's not, but say I had $1, put it in the bank, it will be $1.05 tomorrow. So therefore, if I had $1 tomorrow, my $1 today was actually worth more than the $1 that I had tomorrow, if that makes any sense. Now, this is sort of the big underpinning behind any sort of finance stuff that you will ever do. And just keep that one in mind, that the time value of money is very important. I can have $1, but it depends on when I got that $1. Okay? So the earlier you got the money, the more it's going to be worth, because essentially you've had time to go use it for some purpose, essentially. And the easiest way to think about it is to put that money into the bank, and tomorrow I'll have more money than I had today. Okay? So looking at that second point here, so the value of the project or a company is essentially derived from the present value of its future cash flows. So when you're thinking about deciding whether or not to engage in a project, you've got to think about how much it is to me today. Okay? So let's do an example. Let's say I've got a rice farm. Okay, I've got to invest some money today and buy buy the land, okay? And I know for sure that I'll be getting certain cash flows or certain returns in the future. Say I had to invest $1 million today, and say I know a year from now I'm going to be getting $500,000, and in the second year I'll get another $500,000. Now, in order to determine whether or not that's a good investment, you really got to look at the $500,000 you got in a year's time and another 500 grand 2 years from now, and then think about how much that's worth today. Because you've got a period of time, a year and 2 years respectively, where you could have pretty much invested the money, right? So it's about looking at, firstly, the future cash flows, which is those $500,000, and then bringing it back to today. And how much is it worth today to me? And that's how you decide the value of a company or a project or whatever it must be. So just keep that one in mind. Now, essentially, I've brought up 2 key points, right? Firstly, you've got to determine what your future cash flows are going to be. So what am I going to get in a year's time? What am I going to get in 2 years' time? If I invested $1 million today, what am I actually going to get in terms of, from the perspective of a year's time or 2 years' time, at that point in time, how much I'm getting? And then secondly, what rate do I apply to discount that cash flow amount back to today? So, like I said before, if I had $1, interest 5% becomes $1.05 tomorrow. Now, analogously, if you go the opposite way around, so you can say the discount rate is 5%, and if I had $1.05 tomorrow, if you divide it by 1.05, then you should have $1 today. So it sort of works both ways, and I'll do it when we sort of work on the Excel sort of things, but just, I guess, think back to that $1 example if you're ever stuck on any of that. So 2 things, future cash flows, and then secondly, how do I come up with my discount rate? Now, let's start with the future cash flows part of things. When we look at future cash flows, we like thinking about this thing called free cash flows to the firm. Now, basically, don't have to worry about why the reason is, but there is basically research or whatever. This is what the NPV is about. It's about looking at your future cash flows, and we look at our FCFFs and use that as an indication of our future free cash flows, okay? And I've got a formula up here, which is what you should be looking at in terms of how do I actually calculate the future cash flows, right? Now, the reason it's FCFF is, like, you might ask, like, why isn't it revenues? Why isn't it just looking at costs? Why don't we go all the way down to profits at the very bottom line of the income statement? Now, I don't really know either, but go with EBIT. So there's the answer. So this is sort of the underpinnings of most of the stuff that you should be doing. And we will break down this formula more when I start going through the example that I put up. Okay, so just keep that one in mind, and I'll sort of constantly refer back to this. Now, basically what you'd be given in a general context is, if you have a case, what you'd be given is financial statements. So within historic years, so we're sitting at 2017 now, so you might get a couple of years of financial statements with the company and in terms of how they're performing in the past. And you basically need to use that information to try and forecast out what your expectations of the company are going to be going forward, okay? Now, what I might do, let's just actually jump into, so if you just get the Excel that we were looking at, if you don't want to follow, it's fine, just look up here and I'll do most of it up here. But so this is what a typical financial statement might look like, okay? So firstly, so these are just, okay, a bit of context, this is a retail company. So what they're doing is buying and selling goods, essentially. So if we just look at generally what you'll get is you start with your income statement. This is what it would generally look like, basically like the one that we showed before. Thank you. And then your balance sheet here, which we won't really touch much on, but I just have it there for completeness sake. And then I'll show you how we actually come up with a net present value, essentially. How do we make that decision as to whether or not this is a good project and whether the cash flows are worth it, essentially. Okay, so let's start with the income statement. Now, the one thing to keep in mind here is, I've got it up here, which is typically you use a sales-driven approach. Now, what does that mean? So if we look back to our formula here, we essentially need to go down all the way to EBIT, which is pretty much your revenues minus your expenses, and then you want to take away your depreciation and amortization as well before you get up to your EBIT line. Okay. Now, all of those forecasts, the reason we do the reason it's called a sales-driven model is because all of those forecasts are driven by your revenue line. Okay. Now, that sort of is obviously an implicit assumption, and it should make a lot of sense to you guys that essentially your costs, think about your costs, how much your expenses are going to be. They're generally relatively in line with your revenue, right? So the more revenue you're making, probably the more costs you're going to incur as well. And that's the reason that we use the sales-driven model, making that assumption that everything is mostly linked with revenues. So going back to our spreadsheet here. So we've got a line here which is revenues. So this is how much revenue the company is making each year. Okay? And we want to think about how do we actually forecast what the future revenues are going to be. Okay? So firstly, looking at revenues, there's generally two approaches that we can actually look at this. So in this example, they're making, what, $3.5 billion in financial year 2016. Now, how do we go about projecting that into the next 3 years? Let's just say we want to do 3 years of forecast, right? And these are your future cash flows that we're trying to predict. Now, there's two ways to do it, as I said. It's a top-down approach and a bottom-up approach. Now, the names might sound a bit confusing potentially, but basically, let's start with the top-down. What it is you want to look at anything that is big picture. So what does it mean by the big picture? So we've got a retail company here, essentially, right? The big picture thing is, what is the economy expected to do? What is the industry expected to do? So very large-scale things. Well, where is the economy moving? Where's the Australian economy moving? Where's the Australian retail industry moving? Okay? Think about that in terms of how to do top-down. So let's just start with doing that, actually. So what I might do is, generally with best practice, what you like to do is sort of separate out your actual numbers, which is your income statement, and the assumptions that you made, which is why I've got a little section up the top which says assumptions, so we can sort of look at making our assumptions all together and easy for people to visualize, I guess. So the way we generally look at how revenues grow, and remember that this is a sales-driven model, so everything is ultimately derived from your revenue. So this is quite important in terms of getting this right, I guess. We typically like to look at this thing called revenue growth. So basically, what is the percentage year-on-year growth that is moving with the revenues, essentially? So the way you calculate it is the current year's revenue divided by previous year's minus 1, which gives you the percentage growth. Okay? Now, we just want to move it forward in each year, and just in that way we can tell. So I've just copied and pasted the formula, essentially. So we can see in each year, firstly, they've grown 8.3, 5.7, and then down to 5.3%. So you want to use these historic numbers and your understanding of the business and how the industry is moving to forecast what you think the future cash flows are going to be, essentially. Okay? So again, I'm just going to do these quite arbitrarily. Obviously, there needs to be research that goes into this in terms of what you think the company's going to do. But I'm just going to hold it constant, okay? And I'm just going to say that things are going to be the same. So hold it at 5.3%, and yeah. So that is basically how you do a top-down approach, okay? So filter all of the information that you have into this one number, and then at the end of the day, apply this number into the revenue line. So in order to back out what you, so if you think the growth is going to be 5.3% next year, then in order to get out the actual revenue number, you obviously need to get the previous year's revenue and then times 1 plus the growth rate, right? And that will give you what your growth is going to be. So this is a top-down approach. Now, you might say this is a little bit fluffy and Like, how do you come up with your numbers? Now, as I said before, so this is why I say, I guess, valuations and all of this isn't necessarily the most important part, because I can very easily say this is 5% or 6% or 7%, and it doesn't really make much of a difference. So the real thing that you're concerned with is how you justify your numbers more so than what your numbers actually come out to be. So just keep that one in mind. Now, secondly, we have a bottom-up approach. Now, bottom-up approach focuses on the individual attributes of the company or the certain project. And what that means is, for this retail company here, you can see that its revenues is split into 4 segments, right? From computer hardware to computer games, and then finally DVDs and CDs. Now, what you're really looking at here is thinking about each individual operating segment of the company and then thinking about them individually. Because you might say there's certain drivers that drive the company overall, but actually, you know what? The thing driving computer hardware is actually very different to what's driving DVDs and CDs. I don't know if that's necessarily true, but let's just assume it is. And that's pretty much when you would do a bottom-up approach. Now, it would seem also that a bottom-up approach is actually more rigorous. And that is potentially so, but realistically, from an academic standpoint, it doesn't really matter. So if you think you want to do one over the other and want to save some time and go for the top-down, then go for it. But it does appear, at least, to be more rigorous if you go bottom-up. So I won't do this now, but how you would do bottom-up is instead of, you see how up here with top-down, we just said revenue growth is going to grow at 5.3%. So instead of doing it all together, you would pretty much go, what's the computer hardware growth going to be? And then do that. And then, so you would grow each one of these individually and then aggregate it to get your revenue number, essentially. Okay? So hopefully that makes sense. And that is your bottom-up approach. Now, the most important part was revenues, but the second most important part is your expenses. So how much is it going to cost me to earn my revenue? So expenses, the way you should generally think about them is, I think a good way is to do with fixed and variable costs. Now, what that means is there's different types of expenses. There's different types of expenses. There's certain ones that change with the amount of volume, and there's certain ones that are very much fixed. So the way you can think about it is, let's say fixed, I've got some examples up here, but fixed expenses, think about rent, utilities, admin, advertising, insurance, okay? So actually the one thing I'll say is some of these might actually, in certain contexts, could also be variable. So you really got to dig down and think about, is this expense number going to increase based on the amount of volume of goods that I sell, essentially, is the question you want to ask yourself, okay? So something like rent is typically a fixed expense, right? And especially for retail companies, unless you're thinking about opening up new stores, right? So think about it this way. I've got a store in Broadway, right? And whether I sell 100 iPhones versus selling 200 iPhones, the rent's always going to be constant, right? Because it's that one store and my landowner isn't going to charge me more money because I sold more goods, right? So that's how you think about a fixed cost. Now, a variable cost moves in line with how much volume you're selling. So things like cost of goods sold, raw materials, and stuff like that. So your cost of goods sold obviously should move with your revenue, right? Because as for a retail company, the more iPhones you're selling, the more your cost of goods sold is going to be, because you had to buy it from Apple and then go and sell it off to your consumer, right? Now, the same thing with raw materials. I've got labor there under variable cost, but could potentially be fixed as well. You just got to, again, analyze a certain situation. So do I need to hire more people to sell more goods? Maybe initially the people weren't selling at their full capacity. Maybe not every person was being used in the store to the maximum potential. So it could potentially be fixed for a part and then become variable. So the very important point to keep in mind is some expenses can actually be fixed and variable. Okay? It might be fixed for a certain segment, and then once you meet a certain threshold, it starts to become variable. So I think labor is a good example. Maybe you haven't utilized the maximum efficiency of your people yet. But once you have not enough staff to actually serve all the customers, then it will become variable. So jumping back onto the spreadsheet, if we just move down, what was that? Let's move down to the operating expenses line. So back to this idea of sales-driven model. The way we look at operating expenses is this thing called an operating ratio, which is basically, if you ever hear the word margin, this is basically what it means. So we want to look at what the margins are on this company, essentially. And the way, what an operating ratio is essentially your operating expenses in a given year, and then you want to divide it by your revenue. So what percentage of your revenue are you actually incurring costs at? Okay, so you can see here that it looks like it's sort of increasing. So the company's losing a bit of efficiency, and then slowly, from 2015, it's getting more efficient again. So this is the sort of efficiency standpoint that we generally talk about, is by looking at its margins. Okay, so again, work needs to go into how you think the company is going to operate in terms of how efficiently it's going to be. Now, one thing I might add is generally, in terms of efficiency, it's hard to really realize efficiency gains. And the reason being is sort of cost cutting, it really, I think, depends on what your company's strategy is. So particularly if you think the company is going to do well and you've gone quite aggressive on the revenue forecast, right? It's really hard for them to get more revenue and also become more efficient at the same time. So keep things like that in mind and make sure just the assumptions that you're making aren't overly aggressive and actually do make sense. So that's an important one. Now, I'm going to do what I love doing and just keep it constant, just for simplicity's sake. And basically, same idea here. In order to back out your operating expenses, you apply your percentage back onto your revenue number. Okay, so that's that. And then in order to get your EBITDA, so what your EBITDA is, as I said, is your earnings before interest, tax, depreciation, and amortization. In order to get that, you just sum your revenue and your expenses. Okay? So if you just sum those two, you will get your EBITDA. So those are the two important ones that really do matter. Now I'm going to start talking about a couple that are less important, but still sort of obviously part of your valuation. And one of those is your depreciation and amortization. Now what that is, does anyone want to give it a go? I know you guys are rather quiet and probably don't like me asking questions, but I don't know who's talking and where the voice is coming from. Yeah, well, what do you mean by that? For what reason? I still don't know who's talking. Whose duty? Yeah.
I say it's declining asset value like every year when you hold like plant and capital, plant and equipment. Like you can do it kind of declines in value, the value of that machinery.
Yeah. Yeah, that's exactly right.
I can't really explain it. I probably would. I think it's just a way to actually reduce the tax you're paying. I suppose the government allows you to do it. I'm not sure.
Pretty much. Yeah, essentially, I guess. So what you said is right. It's really, so depreciation and amortization really applies to two key categories. Now, let's just focus on depreciation. So what depreciation applies to is there's this thing called your plant, property, and equipment within your, which is an asset. It's within your non-current assets on your balance sheet. So plant, property, equipment, think about things like machinery, things that you can get a lot of value out of over a long period of time. And your depreciation is how much value your plant, property, and equipment is losing each year. So as you will probably understand, if you've used a machine for a whole year, then it's probably losing value. It's not worth as much as when you first acquired it, essentially. So it's a way of writing off your assets. So your piece of big machinery there is losing a bit of value every year, essentially. And that's what your depreciation is, okay? And for completeness, amortization applies for your intangibles, but we won't talk about that much on that. So just think about depreciation in your plant property and equipment for now. Now, the way I like doing depreciation is, again, just linking it to revenue, okay? So sales-driven approach, let's just assume that the more sales you're getting, the more you're using your equipment, basically, and therefore the more the value of those assets will lose at the same time. So what we'll do is your D&A as a percentage of revenue, okay? So then you basically want to get your D&A and then you want to divide it by your revenue. And same thing going forward, and you can see it's sort of relatively stable, 0.9 over to 1%, which probably means that it's a fair assumption, right? So again, do the same thing. I'm just going to hold it. And honestly, with depreciation and amortization, don't think about it too much. Just keep it constant, take an average, do whatever you want. Just don't think too much on it. Make it simple and just hold it as it would be. Because it's probably a fair assumption that a constant rate will be held in terms of how much D&A you're incurring as a percentage of your revenue. So now to back it out, let's just do the same thing. Do your D&A rate and then times it by your revenue. All right, so you 37, 39, 41, steadily increasing as the company gets bigger, probably quite a fair assumption. Now finally, onto your EBIT line. So what your EBIT is your earnings before interest and tax. So think about the names. Your EBITDA is before depreciation and amortization. Once you take away D&A, then you just get to your EBIT. So what it is just summing your EBITDA and your depreciation and amortization. All right, so this is all we're concerned about up to EBIT. And as you can see with your FCFF formula, we care about EBIT and that's it. So we don't really, yes, there are more line items on the income statement, but who really cares about net interest expense and tax and whatnot? Actually, tax you will consider in the alternate form, just not on the income statement. All right, so that is basically the parts on your income statement that you're really concerned with. So now let's actually go about calculating these future cash flows, okay? So as I said, these are the future cash flows that you ultimately want to discount them and convert them back to how much they're worth today, right? So let's actually go about calculating what each of those, the FCFF in each year is going to be. So all we've done now at the moment is forecast out revenues, expenses, and D&A, and what we're going to think they're going to be for the next 3 years. But that is not the driver of value itself, right? As I said, the driver of value, and to calculate NPV, you want to look at the FCFF. So let's go about calculating that. So we just go down to the bottom section called free cash flow analysis. Now, I've already filled it out for you, but essentially what it is it is just the formula I've put up on the slide. And you can calculate your free cash flows here. And this is basically what you anticipate the company is going to be earning on a free cash flow basis in the following 3 years. So these are the numbers that you need to convert at the end back to today's terms, essentially. Now, one distinction that I probably want to make is, actually no, I'll do that at the end. So now we know what the future cash flows are going to be. Okay, so the next 3 years, this is what the company is getting. So in terms of converting it now back to how much it's worth today, you've got to think about a discount rate, right? Like I mentioned before. So there were two components, as I indicated here. Firstly, your future cash flows, and then what do I divide the numbers by to actually convert it to what it is worth today? So now I'm going to just talk briefly about how you come up with this discount rate. Now, there's a very big word at the top, weighted average cost of capital. Don't worry about terminology, but in finance and how you think about finance is that we think about this thing called a WACC, essentially, as the discount rate. I'll talk briefly about it, but don't sort of take too much to it, I guess. But basically, what your WACC represents is what is your opportunity cost of capital, okay? As we were talking about before, if you have $1 today, how much is it worth tomorrow if I had a 5% interest rate at the bank, right? Now, in that context, we thought about 5% because we thought that was the opportunity cost, right? The opportunity cost is instead of me using it today, I put it in the bank and I get 5% interest on that $1. Now, generally, you got to think about more opportunity costs. So what other things that you can do with the money more than just storing it in the bank. Because you can go and invest it in equity markets, in the debt market, whatever, which will generate a higher return. So it will get you a higher return than just 5%. So in that case, you got to think about what is the sort of return that you're foregoing, basically, on that $1 that you're getting today versus tomorrow. Something like that. Now, I won't go into sort of how to calculate it or anything, but you just have to think about basically what the foregone return is. And as a good general guide, most things you want to discount at around 10%, just as a guide and as a sense check. So keep that one in mind. So what I'll do here is, let's write discount rate. These are just certain inputs. So let's say the discount rate is 10%, as I mentioned. The Australian corporate tax rate is at 30%. So that's how much your money is going to get taxed. So because it's all filled in, you just change the numbers. I find this thing called terminal growth rate. And I won't talk about that yet. Okay, so now you've got 3 years of cash flows now, right? 178, 188, 198. So those are the raw things that are determining what the value of your company or your project is, essentially. Okay? So now we want to convert them back to today's terms. And as I said, use the discount rate. And the discount rate I've assumed up here is 10%. Now, how do you go about converting these numbers back to what it is worth today? So easy way to think about it is, as I said before, $1 today, 5% interest rate becomes $1.05 because you times 1.05, right? Now, in order to convert it back, instead of timesing by 1 plus your discount rate, you should just divide by 1 plus your discount rate to get what it is worth tomorrow back to what it is worth today, essentially. Okay? So just here, your discounted free cash flows, what you need to do is essentially get, this is how much, $178 million is the amount that you're getting in terms of 2017. So in that year, that's how much that money is worth to you. Okay? So then you want to discount that back to today's terms. So you just divide by 1 plus your discount rate. So you want to divide by 1 plus. The discount rate here is 10%. And then you want to, so we'll do that for now. So you want to discount it back to today's terms. So that means $178 a year away from now, at a 10% discount rate, is only worth $162 million to me today. So that's quite, I guess, analogous with my sort of what I said before in terms of $1 today is worth more than $1 tomorrow. Okay? So $178 million a year from now will always be worth less today because you could have invested that money in something, essentially. Now, you need to do the same thing with these future ones as well. Except this $188 million is coming 2 years down the track versus 178 was just next year. So that means, basically, you need to take that, you need to divide by 1 plus your discount rate, which is your 10%. But then you really have to do it to the power of 2 here because we're bringing it back 2 years. Okay? And then a similar thing here, we've got to bring this one back 3 years. So that's how much those respective cash flows are in today's terms, okay? So 178 is 162 today. This 198 is worth 149 million today. So that's how you, I guess, reconcile what you're paying in the beginning versus how much future cash flows you're getting. Now, we've got this concept here called terminal value. Now, what that means is it's a way of getting around one of these common occurrences where you might have a project where cash flows go into perpetuity. So what that means is your future cash flows might not end. So say you've got an investment and you know that cash flows are going to be very, very steady into the forever future, and it just never ends, right? So in that case, you can use this thing called a perpetuity and a terminal value to basically calculate those very far down the track numbers that won't really impact your valuation today. Now, what a perpetuity assumes is that a constant growth rate is happening within a certain future periods. So you might explicitly forecast out a certain number of years, but then you'll get to a certain point where you're just like, well, the company's reached a steady state. They're not really going to change much. So I'm just going to say they're going to grow at 2% every year. Something like that. An assumption like that, basically. So let's just assume that basically we've got 3 years of numbers here. And then after that 3 years, let's say from 4 and onwards, it's just going to grow at some constant rate. And then we can just apply this terminal value to it, essentially. And then that's just a way of simplifying your process, pretty much. Now, a method to do this is something called a Gordon growth model. So this is just a formula, and just remember it. But just remember it, basically. Certain inputs in the formula is your free cash flows in each year, your discount rate, which was your WACC, which is your 10% that I was assuming. And then this thing called a G, which is probably the most important part, which is how much are you assuming the cash flows are growing at in each future year. So I've written down here down the bottom, it should be between inflation and GDP. What that means is you've got, just remember that as a guide, basically between 2 and 3.5%. And the reason being is you don't want it to be less than inflation, because then you've got a dying company, essentially, if it's not growing as fast as inflation. And then if you're growing faster than GDP, then your company or your project per se will eventually grow bigger than the economy, which doesn't really make sense. So keep it between 2 and 3.5%, and you will be fine. So having said that, back to the example, like I said, we want to assume basically after the 3 years, you're going to have the company grow at some terminal growth rate, right? So I said between 2 and 3.5%, let's just say 3%. So I've put it in there, 3%. And now to calculate the terminal value, I'm just going to follow this formula here, essentially. So what you want is the free cash flow in T plus 1. So in order to calculate the Gordon growth model in terms of a given year, you want the next year's cash flow and then divided by your discount rate minus your growth rate. So in this context, basically what you can do is we want to convert it back to this 2019 terms, right? So we really need the 2020 cash flow. Now, the 2020 cash flow is the same as, this might confuse some of you, probably should have written it better, but it's actually the same as this year, but you just grow it by this 3%. Because essentially what you're doing is you're assuming that it's a perpetuity, which means you're growing it at a constant rate. So you're saying that the 198 million, what the 198 million is doing in 2019 is it's essentially growing by 3% every single year afterwards into the forever future, basically, right? So essentially the cash flow in your 2020 year, so in this context, your year 4 basically, is going to be your 198 million and then grow it by your 3%, which is why I've done 198 times 1 plus your 3% up there. Now, just to follow the formula, then you should divide by your discount rate minus your growth rate. Okay, so just following the formula there, and you basically get this $2.9 billion value. Now, the one thing to keep in mind is this $2.9 billion is still in terms of year 3. So that's the value that it equates to in year 3 terms. Okay? So it's saying that you'll get $2.9 billion in year 3. That doesn't mean you'll get $2.9 billion today, because it'll be worth less today compared to what you're getting in year 3. So now what we need to do, just to finish out the NPV calc, present value of future cash flows. I've discounted each one of these cash flows already. So they're all in today's terms, like I described before. So what you can do is you can just sum all of them, and then you'll get a total there. And then here you've got the present value of your terminal value, which was this $2.9 billion, like I said. But remember I mentioned that it's actually still in terms of year 3. So we still got to bring it back 3 years essentially. So the similar thing we did with discounting your 178, 188, and 198. You just want to divide it by 1 plus your rate, your 10% here. And then you want to do 2 to the power of 3 because it's in that year 3 terms. And that brings it back to today, basically. And then finally, that means you can calculate an NPV by summing those two. Now, there's one thing I want to clarify here, which may confuse some of you, but hopefully it doesn't. But this $2.7 billion, what that's saying is, so when you think about NPV, you really got to consider 2 scenarios, essentially. Okay? So I've built out a model, and I haven't really set the exact context to it, but let's assume that what I've built out here is like a base case. So what the company is going to do if it continues as it is going forward, right? So say it's a retail company. Let's say I've made all the assumptions, because as you know up here with revenues and expenses, what I've done is I've just held them constant, right? Essentially what I'm doing is I'm assuming the status quo, that it's going to operate at this exact same level for the next 3 years and also into perpetuity. That it's not really getting more efficient, it's not really getting greater growth in the company either. It's just very sort of steady, I guess. Now, obviously in consulting, what you're trying to do is implement certain strategies, right? You want to think about, if I did this certain investment, if I wanted to undertake this strategy, is it actually going to generate me a higher NPV, or is it going to be value destructive and actually decrease my NPV? So what you should really be doing is building out 2 separate cases. So let's say this case here is my base case, right? And say you've got a certain strategy that you think you need to implement. I don't know, let's say cutting staff or something like that. So then you should really build out a separate case as well on the side that accounts for what you think the impacts are going to be having implemented your strategy. So what that may potentially look like is, let's say I think my strategy is going to be, like I said, cutting staff. Okay. So in order to implement that strategy, you might say that, I don't know, there's going to be a slight revenue impact. Actually, let's do this. So this NPV, assume this is the base case. So NPV here is 2.65 billion. So I'll just copy this here. So keep that number in mind, $2.7 billion. Now let's go up to the top, and let's start fiddling with some things. Okay, let's say the impact on revenue is going to be that it's going to decrease by, I don't know, I'm making this up, 0.1%. Okay, so it's going to decrease by 0.1% each year, so it goes 5.2 to 5.15. Okay, and that's because we're cutting staff, so it's not, the staff aren't always, sorry, let's say the staff, we're losing a bit of staff, so we've got to sacrifice a bit of sales as well. But let's say we take a slight hit in revenue, but on an operating ratio level, so in terms of efficiency on the company, we're actually going to become a lot more efficient. Let's say we go 0.5% less, okay, each year. So you go 93 down to 92.5 and then back down to 92. So let's just assume those are the two things that affect my company when I implement my project of firing, I don't know, 10% of staff or something. So basically once you've built this out, let's go to the bottom and see what the impact is. So obviously everything stays the same. You can see that now this number is $3.2 billion. So what that is telling me is you really got to compare the two numbers, right? So here, after cutting costs and taking a little bit of a hit in revenue, yes, but after cutting those costs out, our company is now worth more than it was before when it was just a status quo. So to keep that in mind, that you've got to sort of compare two scenarios. And in this instance, you've gotten $500 million of extra MPV. And obviously that would imply that it's a very good project and you should cut 10% of your staff. So yeah, that's the one thing to keep in mind. So don't just like calculate it and be like, oh, it's $2.7 billion. That means that's a lot of money. So good project. No, you should compare it with something. So compare between different scenarios and what the status quo is going to be versus what happens once you implement this strategy that you have. Other than that, I think that is me done. I don't think there's any point in me asking if anyone has any questions. Actually, does anyone have any questions? If you're brave enough to ask one now, I will attempt to answer it. But if you're not, I will be around for a little bit, and I'll be happy to... Oh, hello. See, when you have property that increases in value, right? It's not actually affecting your cash flows, so it doesn't necessarily increase the value of your company, if that makes sense, just because your property value is going up. Sorry? Well, then it will go into your revenues. If you're a company that, if you're like Mervac and you're renting out land, then obviously your revenue is from your land. And does that make sense? So your revenue would also go up. So it depends on what kind of company you are, if you're talking about land. So if you're leasing out land, then the impact of your property going up in value would be your rent going up in value, like you said, and that will go into your revenues, right? Because you're earning more money. So you would build that in. So that's how it would impact your MPV, essentially. Does that make sense? Yes? I can't hear you.
How do you get your terminal value? I know you did the Gordon growth model, but how do you exactly got that number?
Which one here?
Yeah, that one, yeah.
Yeah, so I just applied the Gordon growth model. That's it. I can talk about this with you on the side, but I don't want to bore everyone else again. But basically, just all I did is apply this formula and just put the relevant numbers in. So, yep. Can you be louder? Sorry? Yep. No, it's different. It's a little bit different. It's very, very similar. I would, yes, basically, yes.
What about like the goodwill?
Again, so this is talking from a financial standpoint. You don't care about how much assets the company's holding. So goodwill is just an asset to the company, right? That's why in finance, all you care about is the future value. Sorry, your present value of your future cash flows. Goodwill will impact your company in some way in terms of generating more cash flows, but you don't look at the value of the goodwill and somehow just add it onto you having to pay more, if that makes sense. It's the money that's generated out of the goodwill. Same thing like if you have a piece of land, it's the money that's generated out of the land. It's not you having the land and the land's worth $1 million, therefore your company's worth $1 million more. Does that make sense? Cool. Anyone else? Well, cool. Thank you for your time. I'll be sticking around, and if you have any questions, let me know. Oh, sorry. Wait up. Very good. Thank you. Okay, so I'm guessing you're all consultants, budding consultants. The FMAA are running a very good competition that you should all participate in. This is our management consulting case competition. We run it every year. We like to claim to be the largest consulting competition in Australia, which I think we actually are. It's just no one's ever confirmed it, but we're pretty sure it's true. This year we've recently started doing sort of real life cases, and the case this year is a company called Finch, and they're sort of a tech startup. So if you're interested in fintech and just consulting in general, I think it's very interesting to do a competition like this, which is like the founder's going to be sitting there on the panel and judging you. And having that experience, I don't think you necessarily get anywhere else. So very good competition. Teams of 2 to 4. Do you hand out the flyers?
No. We'll hand out the flyers at the very end.
Yeah, my assistant Jonathan will hand out flyers. And the best thing is, if you win, you get money. So if you come first in Australia, you get $2,000. So there's some financial incentive for you as well.
Thanks for everyone. There's pizza that will come around. If you're vegetarian or pescatarian, the pizza will be at the front. We'll take a short intermission of around 10 minutes, and then we'll get into cracking the Australia Post case. Thank you.
If you don't know what pescatarian is, don't put your hand up. No? No vegetarians? Most of my money are you vegetarian? What didn't you order? I'm sorry, this is the vegetarian. Oh, you'll take it anyway, right? Very nice. Why did you guys jump around? Did I say something? No. So I was like, that's the movie. No, I didn't say anything. Because my glasses are here, so I have to I literally have to be there to be able to see shit.
Why did he keep walking around then? Why did he keep walking around? Yeah, right. How do you calculate the cost average? What's capital average? It's actually a very, very long question. Oh, yeah. How did you put this in there? I just assumed it was. Yeah, you like it? But it's just generally it's a guide number. Don't the way that we cost capital is.
And how did you come to terminal value like is it like between GDP and inflation?
Yeah.
So is it how do you come to
Oh, sorry. Between 2 and 3.5%, then you have to think about 3.5 is obviously a company that's growing a lot.
Oh, which is more than inflation?
Okay, and
No. This is a range, right? So it depends on whether you think it's a good company or not. Okay. So if you think it's good, you've got to go higher, right? It's growing more. And if it's shit, then you grow less, obviously. So it's just, again, based on what you think.
So how do you know that it's growing or not without actually calculating the NPV of the business?
just say in Excel.
What the company's doing. Do you think it's a good company or not? Do you think it's your research?
Yeah.
It doesn't matter. I can do it. Does he have a
That's how you
formula?
come to that value.
No, it doesn't matter. I can see in the formula.
Yeah, your terminal growth rate is driven by whether or not the company is a good company or
So is it all about goodwill?
not. It's not goodwill, it's about research. You got to think about it.
I mean different ratios or something is PE, ROA, ROE, debt to equity. Or is it
Oh, no.
There's no one thing that covers it. You
yeah,
gotta,
no, this is my
it's your research. You got
Oh,
to.
thanks. Yeah.
So So you got to think about like something like this. So what's a really bad company?
Which is not growing or which is not.
Let's say West Farms. It's going to grow at 2% because it's very mature. It's not got a lot of growth in the future. 2%. What else? Let's say Atlassian. Fintech company, a lot of growth in the future, maybe close to 3.5. You know what I mean? You got to judge it.
So it can't be more than 3.5.
It can be, but it won't be.
So it depends upon the revenues or something which is generating, which it is generating over the years, or so that I can come to the analysis of the company and come to
Something like that.
value.
And there's no right answer, which is why we say
That's why you always assume this value, and if it's a good company, then maybe it's a bad company.
something like that.
And how do you come to the valuation of the company? If I have to, not market capitalization, just valuation. If I have to
It
value,
would be your
doesn't it have to do something with the assets and all? Looking at the balance sheet, what kind of assets it is. Why did you include this non-operating expenses like advertising, marketing, advertising?
I just did it for simplicity. It would be under. I just did it for simplicity.
So if I come to this EBIT, so
It will be here. It will be in here.
Yeah, so non-operating expenses. So EBIT will be calculated after taking non-operating expenses into account.
Something like that.
So EBIT is like earning before interest, tax, and depreciation of amortization. So there has to be.
Just remember, in a consulting context, they're not like people don't care about.
No, this is my first time I'm attending this course, so I'm like trying to. This one project also to find out what's wrong with the business of looking at the financial statements.
Yeah, and it's really not. It depends. The answer will be it depends. So I need to see it to know what it is. Because if you think about what do you say?
Business master management.
So you're doing a bit of accounting. So it's going to depend. You'll know that companies report certain things in different ways. So it will depend on what the actual thing is for me to comment on where it's going to be.
Is it this NPV's? Is it a significant factor?
No, I wasn't even going to use this, but then I was like, I might as well just do it now.
Is it a Is it a significant considerable factor?
What is?
NPV.
In what?
In terms of which one company is going out or it's a good company to invest in.
It's the only view.
I want to get rid of this,
Basically, it's the main thing you should be looking at.
this line. I want it to be here
Depends what type of company.
or here. So how to do that?
I think he's frozen it.
Predominantly.
It's not a.
Oh, he's frozen it.
I think he's just frozen it. Can you unfreeze
But in a
it?
consulting context, this is where you
Okay. No, here, 2014. Dawen?
I just lost it.
You probably want. Oh yeah, you probably want this one.
No, wrong one. It should be, the line should be there.
Why do you get a box on?
So it needs to be.
Yeah,
Yep. What's this one? This one?
I don't know.
Times.
I can get rid of it. I think it's just,
Plus.
I think he's just done a
Divided
quarter.
by discount rate. It's just the formula. Yeah, it's just the formula. Don't worry about it.
And
And calculate the formula is same because there's used all the
No, that's fine.
This is divided by.
You're gonna have to do it across. You probably can.
My spreadsheet.
No, he wants to use it.
I just wanted this top part because I don't care about all this balance sheet shit.
No, I didn't use it anymore.
Yeah.
I don't know why. Oh, I just realized I never talk about context. when I was meant to.
So how many people do you have doing this thing?
You don't start marketing.
Who's more pizza? Is this the thing? Do you want us to give it out now?
JC, I told you my assistant would give it out. You never gave it
Do you want me to give it out now?
Oh, that's very good.
You can always give it out now and they can ask questions.
Take your laptop away.
Yeah, give it out now.
You can talk to them about it. As a former organizer.
I expect you to do this.
What? Which one?
First table. This is your or mine?
That's mine, bro.
Sorry.
Which first table?
This table right here.
Really? This is a hat.
If there's somewhere I can look at like.
Name and number.
Go ask you stuff, bro. Start now? Okay. Okay. Hey everyone, we're just going to, running a bit short of time, so we're going to just make a start now. So if everyone would like to get ready. Okay. So now we're just going to do a very practical approach to cracking the case, which is Australia Post, if you have been here for the past few weeks. But if you haven't, I'll just run through briefly what we've talked about so far. So we've looked at Australia Post and we've seen that there are three major revenue segments, which is the letters business, the parcels business, and the retails business. And we can see that the letters business is undergoing a structural decline with the volume of letters decreasing substantially. With the parcels business, we've seen that this has been driven by a rapid growth in e-commerce and online shopping. And lastly, with retail's business, it just helps people get their foot into the door. Now, we've looked at Harrison and and Jason were looking at the solutions and the strategies for Australia Post last week. And they looked at priority mail, which was basically a new service where customers pay a premium for their letters to be delivered faster, and expanding their parcel network by increasing the number of online retailers partnered with Australia Post. Now, using those strategies, now we'll go on to forecasting the financials for these two. So looking at, firstly, the solution for priority mail. So in your groups on your desk, I'd just like you to quickly run through how you would actually calculate revenue from this strategy of priority mail. What is this extra revenue that you could get? And the expenses, what are the associated costs with the expenses of implementation? So for revenue, you can think about what Dawen said, top-down approach or bottom-up approach. How would you figure out what revenues there are from this strategy? Or with expenses, you'll need to think about, if I implement this priority mail, what sort of expenses will I incur? Will I need some logistic costs? What will happen? So in your groups, you want to just quickly brainstorm what sort of revenues and expenses you could achieve.
That's why
You need to go around.
Bro, you scared me, bro, and you just said my name randomly.
It was like a new strategy that we are suggesting. So basically, I assume like the customer would pay like a little bit extra to get mail like tomorrow, something like that.
Exactly. So what do you think are the revenues that you would get from getting a priority mail? So I said that they'll pay a bit more so that they can get their letters delivered faster. So how do you think they would charge this? Like, what is the pricing? How do you think we'll get revenue from this?
Yeah, possibly like a fixed charge for per. Depends on the location, I suppose, like the distance. So.
And sort of how soon they want it as well.
Oh yeah.
How do you think you would break it down? If I want you to come up with a revenue number from this solution, so say,
Like
okay,
a proper number, you mean?
no, like how would you get it? How would you achieve
Right.
it? Yeah.
You look at what their current revenue is, and then you'd have like a percentage that you'd increase it by to have the priority mail. So you would do their current revenue times whatever the priority is, maybe.
Yep, so exactly. You could do that. So that's a top-down approach. So you'd say, okay, I think that, so revenue currently is this X amount, and I think that through this strategy, we're going to increase revenue by 3%. So what we did in the first thing, where Dawen was like 3%, and then we'll just grow each revenue out 3% every year. So that's the top-down approach. Do you think, what could you think about from bottom-up approach?
What was the bottom up?
Yeah, what do you mean by bottom up?
So
So you have to
actually
look
think
at
about,
different revenues that already exist within the company.
So not particularly what revenues exist, but it's more like from this strategy, what revenues could we get specifically? Have a think about that. I'll come around.
Thank you.
How are you guys going?
Sorry, I'm not actually listening. I'm just here for numbers.
I have the numbers, but I'm not going to give it to you yet.
But like, the thing is, if you get does the previous slide has the income statements and all that or not?
Well,
I'll put pictures of
I'm more concerned about how you would forecast out these revenues.
Oh, these ones, yeah. Yeah, they have some numbers, but it's not.
But so the more important part is, with these revenues, how do you think you get them? So you can have like a bottom-up approach where you have like price times your quantity, or you could have a top-down approach where you're growing the business revenues every year.
I'll probably say I'm gonna go top-down approach and like the bigger picture.
Okay.
It's bottom up because I'm looking at focusing on individual attributes of the company.
Yeah, you can. Both of them are correct. It's just how in depth you want to go into it, right?
Guys, it's bottom up approach. I would it's bottom up because I want to focus on the
Okay. I'm gonna start tuning. 5.
Can you just do your presentation? Are you in from double A, bro? You got that? Like here, other side. You got that? Like still there. It's like up here. Well, I thought there was.
I can't find anything on it. You're not helping.
I'll explain it again.
Could be like $1, basically. You go to the post office like $1 a stamp. Okay. Now I'm going to introduce this priority matrix.
You can like assume that.
Yeah, that takes can't exactly survive this.
I thought you were leaving.
I need food now. What do I get food for?
Okay, so I'll just run through briefly now after this discussion. So there's a few different ways of forecasting the revenue, expenses, etc. So firstly, from a bottom-up approach, Australia Post could use revenue equals the price times quantity. So price is how much is Australia Post going to charge for this priority mailing, right? And the quantity is going to be who will use the priority mailing service? How many people will switch from normal postage to priority? Are they going to be posting small letters or large letters? We don't know. Those are the things that you might need to consider. From a top-down approach, you could say that we believe that the revenues will grow 4.5% from this solution. And then following what Dawen said, you'll go each year's, so your current revenue times 1 plus 4.5% and keep on doing that until whenever you think that it's going to grow faster or slower. Right? With expenses, the costs associated with the implementation strategy, once again, you can go bottom up or top down. So using the top down approach, you could see what Dawen said with operating ratio. The operating ratio might decrease or increase through this strategy, or you could go for a bottom up approach, which would say, how much would it cost to produce those extra stamps necessary for priority mailing? What are the logistics of priority mailing? So do we need more trucks? Do we need less trucks? How does this work? Machinery-wise, et cetera, et cetera. And with net present value, I'll cover that at the very end. So now, given these pricing strategies, so we'll have small letter, and large letter over 125 grams up to 250 grams. We have the current price and we have the priority pricing. So, and then here we have also the volume. So how much we believe currently, the amount being delivered currently. And you might see that there's volume changes here. As we can see, it's decreasing every single year since 2010. So we're currently in 2015. And also, we have the segments. So we believe that around 83.5% of all letter products are going to be from the businesses. So now, knowing this information, how do you think you would come up with a revenue if you're going from a bottom-up approach? Do you want to quickly take around 5 minutes to come up with any ideas? So if we know all this information, how do you think you could come up with revenue? So we have volume, we have price, we have growth, we have segments, so business segments, 83.5%. How do you think you could come up with revenue from this information? From this strategy?
Like the change in the current price to priority price, that's different for each section, and you look at difference in the volume as well.
Yeah, exactly. Correct. What else? So I want the revenue, right, which is price times quantity. So where would I get the quantity? Okay, so if you would just give it in layman's terms, not the numbers, what would you do?
So you look at priority price times 3 time. So that tells you how much it's worth priority, and then you look at the current price. Again, where it wasn't being used, and you take the previous one from the new one.
Yeah, you could do that. So that is exactly one way you could do it. There are other few ways, like you could take into account the fact that some businesses might sell small letters, some businesses might do large letters, and then break that down even more. So it just really depends on how minute the details you want, how deep you want to go. But normally you might be struggling for time if it's there's time constraints for the case, or you might just think that this is not as important, so you might just go a little bit further down. So like you might just go, okay, so let's just say small letters, and let's just say that it's going to grow at this rate, and then just times it together. And if you even think that it's not important at all, then you can do a top-down approach, where I said it's 4.5% growth, and just grow the revenue out.
This case study, you know how they gave us the case study?
How you guys finding it?
Last week, you know how they gave us
So how do you think you could calculate revenue?
That's when you said all classes.
The volume change in the next
Yeah.
years.
Yeah, and then what would you do?
You're like holding on to yourself, like, oh god. Like, calculate the extra money that higher price, higher
Yeah.
expected.
Yeah. Exactly. That's true. So you can do that, or you can do that top-down approach where you have the 4.5% and then grow out the revenue year by year like that. So it just depends on how important you think revenue is. If you think it's not a very important line item, it's not important to your case, then you don't have to go too in-depth into it. But if you think that, oh, it's really important, I want to get revenue accurate, then you might want to go even further down and say, I want to see how many of that volume of letters being delivered is going to be small letter, how many is going to be large letter up to 125, and split it down even more. But it's all up to you. Like, if you think it's important, then go for it. If you don't, then don't. Like, you can just make assumptions, yeah?
Yeah, what I would do is I would find
this one is that I will find out what you know of break even. Like how to use capital, what's the capital finance. Wait, I'm looking at this one. I press it up. No, I want to know about revenue. Ah. Oh. Do you have any information how we could get a final break even?
Would you like take charge or
Okay, I'll look at the price and the priority price. I'll probably would take advantage of the priority price. How would it increase volume?
Yeah, I would
Well,
consulting
it looks like based on these numbers, okay, these numbers are a bit whack, but based on the volume people are taking advantage of priority pricing, or not many people are mailing letters. Those are the two things that comes to mind. Yeah. So those are the two things that concern. Not many people are using letters, or people are taking advantage of priority pricing. Yeah, we could do that. I'll just go over it real quick.
And we'll show great in depth into
or hyping or
I feel like if you did anything, you would find it pretty cool.
that's so dog. I can't do it.
How bad? You see that?
Yeah. Okay, so I'm just going to quickly go over revenue now because we're running a bit short of time. So from this, I'll just go over here. So what we know is that we have 83.5% of letters are business. So firstly, we can make an assumption that most companies or people that are going to use this priority mailing service are going to be businesses rather than us customers on a day-to-day basis. Yeah. So then we would use that firstly assumption, business letters, and that's going to be ignoring the historical and the year. Let's just say it's going to be 83.5%. Now, secondly, we know that the volume of letters, millions. And we can see here that in FY14, we have around 3,400. Okay. And also, we know that the growth in volume of letters we can see that it's decreasing first year in 2010 at negative 5.3%, then 3.6%, 5.2, 6.8, so on and so forth. And so let's just say that it's going to keep decreasing at the 4% rate in 2015. Yeah. So we can go 2015 negative 4%, and we can just go out to the future. For those wondering how to do straight away, you can just do Control R, and then it'll go all the way across. So now, next, we can look at so actually, let's just find out how much the volume of letters in FY15 to FY19. So what we do, we get this number times by 1 plus the growth, which is negative. And we can keep going out. Yeah. Okay, so we get those numbers. Yep. And we know that the revenue is equal to price times quantity. Yeah. So what I'm going to do is instead of timesing it by the $1.20, which is the priority price, I'm going to times it by the difference in the current price and the priority price. And the main reason for this is because if I just find times by the priority price, right, I'll get the amount of revenue I'll get from this strategy. But it doesn't account for the fact that because people are switching from using the normal services to priority services, that means that the normal revenue is going to decrease, whilst this strategy will take up some of that revenue, right? So instead, I'm going to take the difference because the same amount of people are going to use both the service of letters delivery, and I'm going to find the extra revenue I'll get from this strategy, yeah? So the additional revenue, additional profit, additional revenue is going to be 50 cents, the $1.20. Oh, God. Will be 50 cents, yeah? That $1.20 minus the 0.7, right? And then lastly, before we can actually come up with the the revenue for this strategy, we need to see the percentage of people that are actually going to use priority mailing, right? And this is going to be a very arbitrary assumption. So we don't, in the first year of implementing this strategy, we don't know how many people are actually going to use this service, right? So this is where you actually just need to think of, it's very arbitrary. You just need to think about it and say, don't be too don't overestimate it, but don't underestimate it, I guess. And let's just say it's going to be 10%, right? So then to get the revenue number, we'll get this, it will be equal to the volume of letters times by the percentage of people that are going to use the priority mailing service, which is going to be the 83.5%. And out of those 83.5% of businesses that are going to that use Australia Post to deliver letters, we're going to say that 10% of them are going to actually use this service. So then this number here would indicate that we're going to have $2.73 billion. $273 billion, yeah? And we can do this and we can grow it to the FY19 through, if we go here, we just need to lock the cells. So basically, if you have 83.5%, it's going to stay constant every single year. So to lock the cells, you just go F4. And you can see that there's the dollar signs there. And then similarly, it's going to be, yeah. And then we don't know if the percentage of people using priority services will increase. Oh, yeah. Sorry, your question?
Yes. So you're assuming that 10% of the business letters are going to be
Yep. 10% of the businesses that use Australia Post will be priority mail, yeah? And we don't know if this 10% is going to stay constant or not. So what we can do is just say that, let's say in FY19, we're going to have 30% use priority mailing service. And I can just average out the rest of the numbers. So how I would do that is equals average of the FY15 number with the FY17 number and Control R. And you need to make sure that if you go to options that you have and formulas that you enable iterative calculations. And now you grow out from 10 to 30% each year, averaging it out from the previous year. And now you can just forecast out the formula. So lock this cell. Yeah, so we'll get the revenues for FY15 to FY19 through that. And the most arbitrary assumption that you have here is basically the percentage that are using priority. Yeah. So now we'll look at expenses. So the cost associated with this implementation strategy will probably be in your initial investment, where you need to buy machinery for scanning QR codes, and also sorting of priority mail, right? And also you'll need to have maintenance costs to ensure that this machine is working correctly and that not normal letters are being delivered as priority letters, right? And also with each priority mail, you have a stamp, which has a QR code on it, and you need to produce these stickers, right? So those will all incur costs. So let's say from this data, we have initial investment of $50 million. We have priority mail stamp, which is around $14 million for the first year. So how you can sort of grasp how much these stamps will cost will be, let's say each stamp is 5 cents, and that 5 cents times by the volume of letters that are actually going to be priority mail, and then you'll get your priority mail stamps expenses, right? And then for maintenance costs, it's once again quite arbitrary, but we know from previous weeks that there are around 400 distribution centers, and we can say that every year each distribution center might incur $100,000 in maintenance costs. So if you do the $100,000 times by the 400 distribution centers, we'll get 40 million. Yeah. So once again, these are a little bit arbitrary. However, you'll need to make it as accurate as possible, you should do research and actually see, okay, so if I buy machinery, on average, how much will it cost? If I look at priority mail stamps, what are these stamps like made of? If they're made of paper or whatever, or stickers, so you need to see how much those will cost and then times by the volume. So, and then with maintenance costs, you can have a look at on average in the industry what sort of maintenance costs there are. And so a good use is using IBIS World reports. Those would show you percentage of expenses that are like maintenance, percentage of expenses that are depreciation, as Dawen was saying before. So you should definitely look at those industry reports to get an idea of what those numbers are around. So in FY15, if we sum up these numbers, we'll have 50 plus 14 plus 40. So we'll have 104 million in costs. And this year we'll have 60. Next year we'll have 66. And then the year after is 71. And the year after that is 76. So as you can see, after the initial investment, obviously the expenses would decrease the next year, but then they increase. And the reason for this is because the percentage of people using priority mailing is assumed to grow. And as such, if more people are using this service, then obviously more stickers will need to be produced, etc., which will increase the expenses. So now looking at expanding the network of online retail, which was the next one, today we'll specifically focus on the Iconic, which everyone knows is like the large online shopping. And so if we think about this strategy, we need to look at what sort of revenues there are, right? And the expenses associated. So once again, we can see that Australia Post could make, what the revenues that Australia Post could make from this service, we look at a way that we could do it from a bottom-up approach would be looking at how many households there are on average in Australia, right? And then we can see the average number of parcels of fashion items received per household, and then the growth rate of the number of parcels generated each year. So let's say that this year there's in FY15 or FY14, there's 3.2 parcels being delivered to each household on average per year. Maybe next year there will be more parcels being delivered. So in an industry report, we found out that was 16%. And then out of all those households and all the number of items being delivered each time, we can see that the Iconic has a market share of 10%. So we can use those numbers, multiply them all together, and multiply them by the price per parcel. So if we look here, what we can do is for strategy 2, we have revenues, and we can see that, let's just insert some assumptions. Okay, so we have, let's say, number of households will be, we have in FY14, FY16 is going to be 9.24 because this is already forecasted for us. Yeah. And then in FY21, we have it as 10.1 million. So to be accurate, I'm just doing it as that number over there, and then I'll do the average again. And then we'll see that in FY16 and FY17, 18 and 19, we'll have those numbers. And these ones are sort of irrelevant, but we'll just keep them there for now. Yeah. And then in FY15, let's just take an estimate and say it's 9.1 million. Yep. So we have those projected number of households there. And what we can do is look at the average number of parcels. So average number of parcels are going to be 3.2. And if they're growing at 16%, which I'm going to just write there, growth of parcels, we can see that this will be equal to that times by 1 plus this. There we go. And lock in, remember to lock in your percentage. F4 to lock in percentage. So what we can do now is we have iconic is going to be 10%. And we have that price per parcel is going to be $10. So then what we can do now is find the revenue, right? And what you would basically do is you have 9.1 million households, multiply by the average number of parcels delivered to each household, and times that by 10%, which is the market share of the iconic, and then times it by the price per parcel, which is $10. And then we get 34 million. And once again, if you want to forecast it out for the remaining, we have to lock in the cells. So F14, we just assume that iconic market share stays constant at 10%, and we have price stays constant at 10% as well. And we'll have the forecasted revenue for the iconic. Yeah? And lastly, we'll look at expenses. So there is a very long-winded method from a bottom-up approach where you can look at, so the expenses that are associated could be the initial investment where you'll need more trucks to deliver these parcels. There's fixed costs like rent, lease of extra distribution space, labor maybe, insurance. Your variable costs could be fuel, your road tolls, your maintenance, tire wear, all these different variables. You could go very deep down and build it up from the very bottom. Or you can go from a top-down approach and go, okay, so we think that there is a lot of operational expenses incurred from this strategy, so we'll increase the OPEX ratio. However, what I've done is actually gone on Google, trusty Google, and I've looked at truck logistic costs. Wait, let me just try to find the website. It is called Metrics. So if you don't know anything about the industry and you really are struggling, right, it's better if you have some sort of guide, right, online, or do some industry research on what sort of costs are incurred. And in this case, when I was typing on Google, I happened to come across Freight Metrics. And it tells you basically all the different, so go road and truck operating costs calculator. And then basically, you can look at current fuel costs, the vehicle type, fuel consumption, distance traveled per day, all this different information. And from that, you can find out the cost associated with each one. So this is one way of doing it. Obviously, the other way is if you don't think this is too important and you think that, okay, like this strategy, we can just do it. We don't have that much time. We can just do operating expenses as a percentage of revenue and just do it that way. That's completely fine. It's just how you think you want to build it out, how in-depth you want to go. So this is one way. Another way would be that. Yeah. So I'm not going to go through typing that expenses out right now as we are running out of time. So I'm just going to quickly go over net present value. So net present value, as Dawen was saying, is that we have our EBIT 1 minus T, that formula, right? And that formula seems very complicated, and most of you are going like, why do I need to find this EBIT 1 minus T? Why do I need DNA? Why do I have a change in net working capital? All these different terms that we've never heard of, right? So I'm just going to dumb it down a lot, yeah? And we're just going to look at revenues and expenses, and then we're just going to use those numbers, okay? So from on Australia Post's annual report, we can actually find out what their WACC is. They just give it to you, which is around 7.3%, right? And 7.3%. And we know that in year 1, so let's just go 1, 2, 3, 4, and 5. And we'll just do this for the strategy of solution 1, which is priority mailing. So we know that we have those revenues right here. And what we're going to do is, let's just say that to get profit, we'll get our revenue and you'll minus your expenses. And we'll do that for all the other ones. So we get those revenues, right? And what we're going to do after this is normally you would have to times by you need to subtract your depreciation and amortization, and then you need to times by 1 minus T, which is your tax, yeah? In this case, let's just say there is no depreciation and amortization for simplicity's sake. And let's just say we will do the 1 minus T. So we'll have 30% tax rate at 30%. So what we can do is do equals to this times by 1 minus that, lock it, and then you'll get these. So this will be the operating profit in this, or let's just say free cash flows in terms of what was previously said. So once you get the FCFFs, now we need to discount it, right? And we have found out on the Australia Post annual report that the discount rate is 7.3%. So what we can do is do this divided by 1 plus that to the power of 1 and lock the discount rate in and then go all the way out. So then it seems to me that this, to get the action, and then, oh, I forgot about terminal value. So terminal value is what Dawen said is if you think that the cash flows are going to go into perpetuity. So for an infinite number of time, right? And for this strategy, we don't know how long it'll go for because volume of letters is going to decline as well. So if you have a company that is in a declining stage and you don't think the revenues and the cash flows are going to be stable, it's really hard to do a terminal value. So in this case, we're just going to say that this strategy is only for a very short-term approach, which is going to be around 5 years, yeah? And we're just going to do the net present value of these 5 years. And so that's why I won't talk about terminal value, and we'll just sum these one up. And it looks like we're going to receive 1.1 billion in revenue from this strategy. So this is a great project. We should definitely undertake this project. And now I'd just like to stop it there. If you have any questions, you can come up and ask me or any of the SCC members. And before you guys get up and leave, the President, Ricky, would like to say some words.
Thank you. Oh, did you delete the
thing already? Which the presentation? Where is it?
It's the PDF.
All right. Sorry. Let me just get to it. It helps. So yeah, thank you for coming once again. I know today's workshop was probably very, very... Who found it like very difficult? Just curious. Okay, good. Good to hear. We will try and make it a bit easier. So next week we're doing slide making, and I'll be taking it. Hurrah, I'm back. The only good speaker, guys. I'm joking. So next week we're going to go through how to make PowerPoint slides. We're going to try and make it like very interactive. So you guys will be working in a team. I will be, today, like Jonathan and Dawen were going through all these things like with all these shortcuts and you guys had no idea what was going on. Next week, I will actually show you how to do those shortcuts. But no, so seriously, we will show you how to do those shortcuts. We'll try and give you a demonstration of how to make really nice slides. So that's next week, and it will be in the same room. Fingers crossed they don't kick us out again. We do have a feedback form. We say it every week. We do really appreciate the feedback. One of the reasons why I'm back next week is because the feedback for the first session was good. They didn't say Ricky was a shit speaker. Thank goodness. So please sort of give us some feedback so we know what we can do next time to improve it. I know today's workshop was very heavy, content heavy, and was very difficult. We will post this video up once we get the feedback that we need. So yeah, thanks for that. And yeah, if you have any other questions, you want to know a little bit more, if you don't understand anything about today's workshop, come and see us. We'll try and, give you as much like in the meantime. So yeah, other than that, thank you for coming and we'll see you next week.